Understanding international economics is paramount for informed decision-making in today's interconnected global economy. For economists, investors, and policymakers, grasping concepts like exchange rates, currency appreciation/depreciation, and purchasing power parity (PPP) is crucial for market analysis, policy formulation, and investment strategy. An exchange rate defines the price of one currency relative to another, directly impacting trade flows and capital movements. The nominal exchange rate, NER, is the direct quote, while the real exchange rate, RER, adjusts for price level differences, reflecting true purchasing power. For instance, if the USD by EUR, NER is 0.90, but US inflation outpaces the Eurozone, the RER shifts, affecting the competitiveness of goods. The Big Mac Index offers a practical, albeit informal, gauge of currency valuation. If a Big Mac costs $5 in the US and $3 equivalent in China, the yuan appears undervalued against the dollar, signaling potential market inefficiencies or policy implications. Currency appreciation signifies an increase in a currency's value, making imports cheaper and exports more expensive. Conversely, depreciation denotes a decrease, boosting exports but raising import costs. These shifts profoundly influence national competitiveness and corporate profitability. Consider the British pound's sharp depreciation in 1992, driven by speculative pressure and policy shifts. This event underscored how market forces can rapidly reprice currencies, impacting trade balances and investment returns. Similarly, the Japanese yen's appreciation in the early 2010s made Japanese exports less competitive, affecting corporate earnings and trade surpluses. PP theory posits that, in the long run, exchange rates should adjust so identical goods cost the same across countries when priced in a common currency. This basket of goods approach provides a theoretical benchmark for currency valuation. For example, if a basket costs $100 in the US and £80 in the UK, the PPP exchange rate is $1 equals 80 British pence. PPP-adjusted GDP is widely used by institutions like the World Bank to compare living standards, offering a more accurate cross-country comparison than nominal GDP. However, PPP has limitations, including transportation costs, trade barriers, and non-tradable goods, which cause short-run deviations. Persistent deviations from PPP can signal currency misalignments, influencing trade balances and prompting policy responses. Central banks may intervene to stabilize exchange rates or achieve macroeconomic objectives. Understanding these dynamics is vital for policymakers crafting trade policies, investors assessing market risks, and businesses planning international operations. Mastering international economics concepts is indispensable for navigating the complexities of the global financial landscape. These analytical tools empower economists to forecast trends, investors to optimize portfolios, and policymakers to formulate effective strategies. Leverage this knowledge to enhance your strategic foresight and decision-making in an ever-evolving global economy.